Welcome to Backdoor Roth Timing Secrets. In this video, we'll unpack how high-income earners can legally get money into a Roth IRA using the backdoor strategy, the exact timing rules that trip people up, and what to do about the Pro-Rata Rule. We will move step by step, and by the end, you will know the practical playbook, common pitfalls, and reporting requirements so you can speak confidently with your tax professional. Here's the agenda. First, we define the backdoor Roth and why high-income earners use it. Then we explain the Pro-Rata Rule and how it creates unexpected taxes. Next, we show you how to clear the decks by moving pre-tax IRA money into an employer plan to avoid the rule. We will walk through the two critical tax dates, compare doing everything in the same calendar year versus splitting across year ends, review reporting using IRS Form 8606, and finish with common pitfalls and quick quizzes to reinforce learning. This video is for people whose income phases them out of making a direct Roth IRA contribution. The strategy is a legal workaround commonly called the backdoor Roth. Next, we will cover how it works at a high level so you have the right mental model. The backdoor Roth has two distinct steps. First, you make a non-deductible contribution to a traditional IRA. This is after-tax money and will create basis that you must track. Second, you convert that exact amount to a Roth IRA. The purpose is to move funds into Roth where future qualified withdrawals are tax-free. Success depends on timing and proper tracking of your basis using IRS Form 8606. Next, we'll look at the Pro-Rata Rule that can make the conversion unexpectedly taxable if not handled correctly. The Pro-Rata Rule aggregates all of your traditional, SEP, and SIMPLE IRA balances across all custodians as of December 31st of the conversion year. If you hold any pre-tax balance on that date, your conversion is treated proportionally as coming from both pre-tax and after-tax funds, making part of the conversion taxable. Importantly, employer plans like 401k and 403b are not included in the aggregation for this rule. Therefore, to avoid a partially taxable conversion, you need to approach your balances proactively. Next, we'll discuss the practical way to avoid this problem. To eliminate the pro-rata issue, the priority is to ensure that your total pre-tax IRA balance is zero on December 31st of the conversion year. The common approach is to roll existing pre-tax IRA funds into a current employer plan like a 401k or 403b, provided it accepts roll-ins, ideally well before year-end. Review the plan's rules, fees, and investment lineup. If your plan does not accept roll-ins, you might delay the conversion or evaluate other options with a professional. With the decks cleared, your conversion should be nearly or entirely non-taxable, assuming only after-tax basis remains in your IRA. Now let's time the two critical tax dates correctly. There are two distinct dates. First, the contribution date. You may make a traditional IRA contribution for the prior tax year until the tax filing deadline, typically in mid-April, not including extensions. Second, the conversion date. Your Roth conversion is taxed and reported in the calendar year the conversion occurs, regardless of which year the contribution belongs to. Therefore, it is normal to have split reporting across years if you contribute for a prior year and convert in the following calendar year. IRS Form 8606 handles both the basis from non-deductible contributions and the conversion reporting. Next, let's compare doing everything in the same year versus splitting across years. In a same-year approach, you contribute and convert within the same calendar year. This feels simple and consolidates paperwork. However, you still must ensure there are no pre-tax IRA balances on December 31st of that same year. In the split-year approach, you might contribute for the prior year early in the new year, then convert later that same new year. This offers flexibility to complete any roll-ins to employer plans before December 31st. The trade-off is that reporting spans 2 years, though Form 8606 is designed to handle this without significant complexity if completed correctly. Next, let's solidify your understanding with a quick quiz. Quiz time. For the Pro-Rata Rule, which account balances are checked on December 31st of the conversion year? Option A. Only the traditional IRA used for the contribution. Option B. All traditional, SEP, and SIMPLE IRAs in your name, aggregated. Option C. Only your current employer's 401k balance. Option D. Only Roth IRAs. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is all traditional, SEP, and simple IRAs aggregated under your name. Employer plans, such as 401k and 403b, are excluded from this aggregation. This is why rolling pre-tax IRA amounts into an employer plan can eliminate the pro-rata issue. Next, we will walk through the reporting mechanics on IRS Form 8606. Form 8606 is your record keeper. In Part 1, you report non-deductible traditional IRA contributions and track your accumulated after-tax basis. In Part 2, you report the conversion and compute the taxable and non-taxable portions according to the pro-rata calculation, if applicable. You will also receive Form 1099-R for the year you convert. Accurate records of when and how much you contributed and converted are essential. Now let's test timing knowledge with one more quick scenario. Here's a timing scenario. You contribute for tax year 2025 in February 2026 and convert in February 2026. How is it reported? Option A, both contribution and conversion on the 2025 return. Option B, contribution on 2026, conversion on 2025. Option C, contribution on 2025, conversion on 2026. Option D, both on 2026 because you did both in 2026. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is contribution on 2025 and conversion on 2026. The contribution is reported for the tax year it is designated for, which is 2025, even though you made it in February 2026. The conversion is reported in the calendar year it occurs, which is 2026. This is a normal split handled by Form 8606. Next, we will reinforce timing with a visual timeline and a quick date table. This timeline shows how contribution and conversion can span 2 years. Anchor your planning around December 31st, since the pro-rata rule is determined by your year-end IRA balances. Work backward from that date to complete any roll-ins to a 401k or 403b. Then make the non-deductible contribution and conversion in an orderly sequence. Maintain clear records and confirmations. Next, a compact table will summarize date rules. This table consolidates the key date mechanics. Contributions are tied to the tax year they are designated for and can be made up until the filing deadline. Conversions are tied to the calendar year in which they occur and are reported in that year. The pro-rata rule depends on the December 31st balances across all traditional, SEP, and simple IRAs and influences how much of the conversion is taxable. Avoid these mistakes. First, do not forget to eliminate pre-tax IRA balances before December 31st of the conversion year. Remember that employer plans are not part of the pro-rata aggregation. Always file Form 8606 when you make non-deductible contributions or convert. Confirm that your contribution is non-deductible if that is your intent, because deducting it alters your basis. Start roll-in paperwork early to meet the plan's operational timelines. Finally, track your basis year to year so you do not overpay taxes later. Next, let's summarize your Backdoor Roth playbook in a concise checklist you can screenshot. Here is a simple checklist to operationalize the Backdoor Roth. Verify that your income truly blocks direct Roth contributions. Confirm in writing that your employer plan accepts incoming rollovers and start that process early. Ensure your pre-tax IRA balance is zero by December 31st of the conversion year. Make the non-deductible traditional IRA contribution, convert to Roth shortly after, and then file Form 8606 correctly. Keep all statements and confirmations for your records. Next, let's add an important disclaimer. Disclaimer. This content is educational and general in nature. It is not tax, legal, or investment advice. Individual circumstances vary widely. Consult a qualified CPA or fiduciary financial advisor before implementing any strategy. Tax laws and plan rules change. Verify current requirements and plan provisions. Now, let's wrap up with key takeaways. These are the core takeaways. The Backdoor Roth is a two-step process. The pro-rata rule is determined by your year-end IRA balances, so clearing the decks is crucial. Contributions belong to the tax year they are designated for, while conversions are reported in the calendar year they occur. Split reporting is normal, and Form 8606 is designed to handle it. maintain documentation, and confirm employer plan roll-in rules early to avoid delays. We have covered the strategy, timing, and risk points so you can discuss and plan confidently. Choose a same-year or split-year approach, clear the decks, and document everything. Use Form 8606 to report your basis and conversions properly. Your action item is to map your dates and begin any roll-in paperwork early enough to meet the December 31st deadline. Thank you for watching. If this helped you avoid the pro-rata surprise, please like the video, share it with someone who needs it, and subscribe for more practical tax and retirement strategies. Post your questions and timing experiences in the comments so others can learn from them as well.